I thought what I would do this morning is talk a little bit about global investors and how they're thinking about things. And I know the day is going to be largely focused on Europe, but maybe start a little broader because, as everyone knows, we're probably into about the I don't know 40th year of globalization of the real estate market, and I'd say picks up pace every year in terms of the flow of capital and ideas around the world. And it is falling around mid-year, which is also, I think, always a good time to regroup and sort of rethink what you thought might happen in the course of the year. So by way of a little bit of background, we publish every year at the beginning of the year our views. We used to call these quarterly market commentaries, but then we realized that would obligate us to do them quarterly. So now we just call them market commentaries, and they come out episodically. But what did we think coming into 2015? And again, thinking about it from the global perspective, our view was then and remains that everybody focuses on the many risks that exist around the world, whether they're capital market, geopolitical risks, or very specific to a local real estate market. These risks exist, but we felt that markets would generally remain pretty vibrant and pretty optimistic. And based on kind of activity to date, I'd say that has certainly been borne out. We felt that capital was going to continue to flow at a significant pace into real estate via funds, joint ventures, and direct investments. And year to date, this has certainly again been borne out. Just looking at fund statistics, about 30 billion went into funds in the first quarter, and these tend to be the higher yield funds, versus about 22 billion in the first quarter of 2014. And if you speak with the large brokerages, they will all tell you that deal activity is stronger this year than last year. So continues this momentum. We felt that investors would continue to look globally to satisfy their real estate allocations, and not just look globally, but across all the risk spectrums, from core all the way up to distressed and opportunistic. And here again, that's been borne out. We felt that credit strategies would be attractive to investors, given the lack of current return in most of their typical alternatives across the fixed income opportunities. And likewise, this has maintained its kind of position. We felt that Europe was going to attract an accelerating pool of capital, and again, this appears to be the case. Then the question, of course, well, here we are mid-year, investors, everything seems fine, capital is flowing, investors have a lot of capital to deploy, and real estate has not just maintained, but in some cases increased its hold on allocations. That said, institutional memories are very strong. They remain very strong. We'll say maybe less so among some of the lenders in the world, but to the institutional investors who report quarterly to a board and are still reporting information about deals made in 2004, 5, 6, and 7, it's kind of fresh in their mind. And as they have improved their track records inside these institutions, they are reluctant to revisit those dark days when they had nothing but bad news to report. Leverage levels across institutional portfolios remain pretty strong, but that doesn't mean that everything is fine. I think we all know that lending standards have started to deteriorate a bit. People can point at either the quality of collateral going into current CMBS, or even just the fact that a few years ago most investors thought that 65% was a high leverage level, and now we're hearing 75, 80, and higher. And mezzanine strategies that used to top out in the low 70s seem to be creeping back up into the 80s. So these are perceptible shifts, usually born out of optimism, and sometimes results in less optimism in the future. Fundamentals, and I know there's going to be a very good presentation just following, so I'll get out of the way quickly on what's really happening on the ground across Europe. But across Europe, and I say across most markets around the world, the fundamentals are improving. I'd say there's a couple of markets, probably not so much. China, Brazil being two visible ones. We'll leave Russia out of this. I don't know if we get into that at all today. But if you think about the developed markets of UK, Europe, North America, and even many, many parts of Asia, the fundamentals are improving, and it's been sort of a slow path to recovery. It's taken a long time for these economies to rebound, but finally starting to see some of the results in terms of rising demand employment growth, and the take-up of space. People have been fussing about the impact of rising interest rates for a long time, but I think over the last 12 months or so, and again, this feels like it's an accelerating theme, investors have come around to the view that they've been hearing from a lot of people that if rates rise, it's not so bad. Why? Well, if rates rise, there's the implicit acknowledgement that there must be growth happening somewhere. Therefore, all these pro formas that we pour over will show, we sort of think 3% growth, that seems fair. That's assuming a very low growth environment. So if interest rates are rising, maybe growth's going to be better than 3%. You can grow your NOI, you'll magically, make up the difference if you buy at a 5 and suddenly a 6.5% cap rate market. So do we want to disturb that theme? I don't know. We can all run the math. You know how much NOI growth you have if you have a 20% expansion in cap rates. But for long-term investors, they take the view, if you buy the right assets, you can wait it out. And these are paper losses, if any. And if you're not highly levered, you ought to be able to see it through. I'd say the other thing that we have experienced has been a real concentration of where the capital goes in terms of managers. And I think everybody knows about what we in the funds world call the Blackstone effect. But it's not just Blackstone. The largest three private fund managers accounted for about 60% of the capital that closed into funds in the first quarter. And it's indicative of a lot of things, not just that they can absorb large investments from large institutions. I think it's also sense that maybe those are going to be more stable platforms going forward. It's a big debate going on. Frankly, it seems a bit odd that you can just sort of pile on it. I'm not picking on any of them. They're all great managers, but it does seem odd that the diligence can be done in 45 minutes based on, well, who else is in it? And if it's everybody, then you take comfort and move along. So what are the investor hot buttons? And I'll try to go faster here. I would say it's a residual mistrust of the fund managers following the financial crisis. They talk about wanting a kill switch on their funds now, the fear that capital gets called for the wrong reasons at the wrong time. In some cases, capital wasn't getting called because the manager themselves did not have their co-invest available. We don't sense that that's going to change a lot in the larger funds, but we're seeing a lot of trading that goes on in the smaller funds. The other thing we're seeing is that capital is coming back to investors a lot faster than they had expected, and we've been hearing this for about the last 18 months or so. And what does that mean? Well, they're in funds, they're putting out capital, and it takes 18 months, not 36 or 48 months to execute a plan, or at least to have someone believe that the value creation has occurred. And we're seeing a lot of that. As more funds get raised, new managers are prepared to buy into somebody's prior investment on the basis that, well, they're halfway through the value add, we'll pay them as if they're done, and then we'll take it through our value add. And it's kind of creating a bit of I'll just call it a cycle. But the other side of it, and this maybe goes back to some of the mistrust, one of my friends on the investor side says they sell the winners and we get stuck with the dregs. So what they're seeing getting sold are the deals done post-financial crisis. Shockingly, those are paying carried interest. And the deals that are not selling are pre-financial crisis, and they're kind of grinding along. So I think that is going to have to work its way through before this residual mistrust ultimately goes away. Real estate chief investment officers inside these institutions are getting a lot of pressure from their CIOs to get capital out, and that creates both a good and a bad dynamic. The CIOs need yield. They've got, if they got liabilities, they need current return to pay those liabilities, and the real estate investment officers are protecting their own track records on the basis that it took them a long time to get out of the hole they dug. So the general message is go invest money but don't lose any, and that's always tricky, especially in a market that's 5 or 6 years into recovery. But again, where we take comfort, they've reaffirmed their commitment to the asset class in a big way. I think some of you may have seen we publish other research where we work with the Cornell Baker School of Real Estate. It's called the Allocations Monitor, and really what we're trying to determine on a large scale among global institutions is how much capital do they really have and what are they planning to target for real estate. We're just refreshing the monitor this quarter, but based on last year's number, the target is 9.5% of institutional portfolios, and this is off of a base of about 8 trillion of institutional investors, not managers, but just the institutions themselves. That 9.5% was up about 50 basis points from 2013 to 2014. But what's really interesting is that as a whole, this 8.5 trillion or so is 110 basis points under invested based on their target allocation. The early days, we've got about a third of the responses back, and we haven't started really digging through the data yet, but it looks like all of those numbers have risen, in part because there's more capital flowing, despite the fact that a lot of the capital represents oil and things that come out of the ground. But the allocations are increasing, and the pace of getting the capital deployed is not. So we will expect to see some widening of that 110 basis point gap going forward. I just want to talk briefly on the sovereign wealth funds. I don't think we can talk about Europe without kind of the impact that they're having. At last count, there's about 6 trillion sitting in about 30 funds or so. And despite the decline in oil prices, there's been really no abatement in their activity. Any abatement's been taken up by Chinese insurance companies and other large institutions that are starting to think globally. Europe is a huge target for these investors. For one thing, it's a little more tax friendly. It's highly targeted though at major cities, major markets. I'm sure we'll hear it's really driving prices and creating very substantial differential in return between central cities in like London and the periphery. That's going to start to get taken up, we think, just given that the value add and opportunistic funds are also targeting these markets, and they can't compete. And even though it's maybe the sovereign funds that are focusing on trophies, maybe it's only representing 1% of the stock, it still has that uplifting effect. If somebody sells an asset at a 3 cap, everybody assumes theirs is entitled to a 3 cap, and even if it's a 5, it somehow magically becomes a 4.5 as a result of the weight of capital. So that is really the role of the sovereigns, is to kind of keep that market flowing. But what's really relevant, and you see it more in Europe than any place else, they're building global organizations, they're putting a lot of people on the ground. So I don't think the market gets any less competitive, barring a big surprise and a kind of, I would say, a calamity of some form. So with specific reference to Europe, just a couple more comments and then I'll turn over to next speaker. But very strong investor demand for Europe. Why? Everyone likes a good narrative, and the European narrative right now is one like we're 2 to 4 years behind the UK and the US, therefore there's opportunity. It's always interesting when people sort of land in London and say, okay, tell me, where should I invest in Europe? And you start naming places they've not heard of. They've heard of the major cities, they haven't heard of the second and third tier cities. Europe, like the United States, is not a homogeneous entity, and probably more startling, even inside countries, there are regional differences, and what you might do in one part of Spain is very different than what you might invest in another part of Spain. I think conferences like this will help to kind of educate investors, but they like the distress story, and it has been a good one. The bank distress is partly worked through, not entirely worked through, but folks like Cerberus and Lone Star, who've been really focused on the non-performing loan activity, is catching a lot of headlines. There are single assets that are falling out of those situations that are large, and so other investors such as Blackstone and others are pursuing those strategies. And then there's a lot in between, which is the simple kind of application of good ideas and elbow grease to take an asset, fix it up, and really just bring it to market. Given what people expect will be an improving economic environment, those opportunities are growing, and investors perceive that if you can achieve those results in the U.S., which I think most people just generally feel, tax aside, is a safer place to put your capital, they're happy to pile in, and I think we're seeing a little bit of the pile in. It has been an on-off switch with Europe, mostly off. It switched on about 2 years ago, had a brief flurry last summer where it felt like the switch was off, but the switch is definitely on. So I think what you'll hear today is how much of that on switch is going to be met by actual operating fundamental improvements. I'll move on now, but the year ahead, continuation of substantial flows into real estate, not shocking news to anybody, so I'm not going to belabor the point. We think there's hope for the little guys, the funds that aren't Blackstone, Starwood, Lone Star, Brookfield. that there are mid-market investors, investment managers that are finding good deal flow, and maybe without the substantial weight of capital on them that some of the larger institutional fund managers have, just might generate a little better result. We continue to see realizations from all vintages. We think that is going to actually accelerate as there's a very strong bid for just about anything. And then we do expect, though, that some of the emerging markets, particularly in Central and Eastern Europe, may surprise to the downside. There seems to be a general kind of shift away. Emerging markets globally took a lot of hits over the last couple of years, starting in China, then moving to Brazil. Obviously, if you own big assets in Russia, you're scratching your head a little bit about the liquidity out there. But we think that there's, as money is moving to Europe, we think actually Central and Eastern Europe will probably not get its fair share. But with that, I'll turn over to the real experts who are going to put up some slides and either prove or disprove. But hopefully it's a good start to the day, and it should be a good program today. Thank you.
Great, thank you.